Welcome to our Miami Beach Markets Happy Hour podcast, recording on a Tuesday, December 9th. I mentioned that because obviously with news changing, we need to get a good read on what's happening in any one day. Podcast, is the water warm? Because we're obviously here in Miami, the water probably is warm, but the question is it safe to get in the water or should we be getting out of the water? And I think if we were to look at what the various prognosticators, commentators are saying right now, you would think that things are very rosy, very strong, positive outlooks for 26. And as far as we think there are actually many risks there that would make you want to at least decide which part of the water you want to be in and whether you want to maybe move around a little. And so this is the idea here that whether investors should be thinking as we approach year end, just about how much they should be staying in different asset classes. In terms of what we talk about every week, so this is a weekly podcast. I'm actually recording it twice this week. We're recording it tomorrow again. We speak about inflation, interest rates, equity markets, geopolitics, and other asset classes. So think of it as the five fingers of the hand. And why do we have something as kind of comprehensive as that? Is because our clients generally want to hear from us about these sort of indicators that are generally grabbing headlines, and also, more importantly, reflect on what it means for them in their portfolio. So a couple of sub-themes this week. So we have had a surprisingly buoyant holiday season, despite the fact of having this K-shaped recovery and wondering how the consumer at the lower end is likely to fare. We have the phenomenon in bonds behaving a little strangely, seemingly underestimating perhaps any risks in markets, any fears. And we also seem to be all consolidating behind a belief that interest rate cuts are coming now. But still, it's a bit hard to reconcile the complete lack of belief in, I should go back to that for a second. And the rest of it is the rest of the credit story. Is there, we've got some people, some experts here who are immersed in private credit all day long. Is there risk essentially being pushed from fixed income into the private credit sector? Is that where there is maybe the next shoe to drop? Equity expectations, very buoyant, soaring. And there's some interesting charts I have here about real estate. Perhaps a multitude of problems. We talked about cockroaches in the private credit arena, but are there a few cockroaches in real estate? And then are there some surprisingly buoyant parts of real estate that we aren't thinking about? So we're in Florida. It's usually a good place to think about real estate. So the first thing I usually talk about is inflation and sentiment and do sort of a vibe check on the economy. And the interesting thing about sentiment has been it seems to really depend on where your political orientation is. In that if you believe that inflation is going down, if you believe that affordability is being tackled, chances are you're Republican, just based on this, or vice versa. But there is definitely a divide in terms of outlook around inflation and consumer sentiment. There's another chart I've shown, which also shows this chart is highly dependent on the shares, whether you own shares or not. So if you're participating, again, more of that K-shape in the buoyancy of the economy, you're participating, then you may not be seeing some of the woe and the affordability crisis because your 401k is doing quite well. But I'd say on the other side, when we have this, the job side, which is obviously we're looking at, we've had this absence of data. We have seen jobs being a little more buoyant than we thought in September. That may ultimately just detract from the direction of travel we think we're seeing with the Fed, but still it's been there. So this is where I usually throw it open to the floor and ask for any comments or feedback on this economy vibe check. Do you feel a disconnect between the buoyancy in markets, these strong 2026 forecasts, which seem to be uniformly strong, and the nagging sense on the ground that people can't afford to buy Chipotle or buy Panera sandwiches? Anyone got thoughts on that disconnect?
Static basket of 30 of goods from Whole Foods, same basket, whatever that basket is, it's up 30% year over year. So inflation is radically higher than reported, and that's the pall of quiet despair that's, I think, breathing in this economy.
That's a nice way to describe it, a nice sad way to describe it, but I think it does. It's that quiet despair. Yeah.
I think things continue to be expensive, but I also think it's magnified depending upon where you live in the country. Miami is significant, and even if you break Miami into various sectors, there's certain parts of Miami that are more expensive than others. You mentioned Chipotle, and so I took my son to Chipotle a few weeks ago, and it was $40 for the two of us in Miami. Then I went to Palm Beach County in more of a planned community. I thought, oh, it's going to be cheaper, and it was the same price. So, but I think that the inflation is still there. I just think that it's also regional as well, and regional within the cities.
Yeah, and even internationally. Like I'm on the road 200 days a year, and I'll be in Saudi or Europe or Asia, and it's like Taiwan was cheaper, but everywhere else, like it's really bloody expensive for everything. And I go back to Toronto, and it's like, geez, it's more here too.
This is cumulative. So yes, inflation may be down, maybe lower, but that doesn't mean prices are falling. I think that's the narrative that gets distorted in the media. And so that would definitely square. And I think, that is the bit that is not really being reflected in this buoyancy in markets. So maybe it's that there's the basket they're taking to say Thanksgiving's cheaper this year is a much more reduced basket. And, that kind of shrinkflation that we're seeing. But it's interesting that with all that, doesn't seem like anyone would disagree with that thesis. Moving then to the direction of rates. So I've had this concept of this table mountain for some time with rates. They went up, they stayed stable for a while, and then we're beginning the descent. There's a lot of discussion about the descent being the most dangerous part, the part where you can really trip and get it wrong, and also how challenging that last mile is, whether it's inflation reduction or even getting interest rates down. So it does seem that we are kind of almost unanimously forecasting a rate cut now next year. The next meeting this week, and December 10th, and whether this will continue next year. A little bit of question mark. I think some remarks from Kevin Hassett we're seeing as a little bit less dovish in just the recent day, and equally with employment numbers being higher, maybe we're not looking at that. But what I think is quite interesting is that just the US is going to be a bit of an outlier if it does proceed for full-blown quantitative easing and or interest rate reductions. If we compare it to central banks around the world, it is the ECB is even being looked at that it may now flatten from here and its next rise may be upwards, which would be surprising in terms of an economy that's clearly not overheating and doesn't have much of an inflation problem. So that was a little surprising to me to hear that. That could also be very bearish for the dollar if we see the euro rate rise. But the interesting part is if we look at the Fed here is the red line, that the Fed could be going down, whereas Bank of Australia heading up, Bank of China here basically heading up, and the ECB heading up. So will the US be an outlier? Ironically, given it seems to be the center of US exceptionalism and outperformance. So this, I suppose, begs the question as to is this what this rate cut could in fact do? I thought there were some interesting other comments this week about China. And I think if we're talking about geopolitics and equity markets, perhaps you can see a little bit, you can't really see any charts back there. Just in terms of the trade surplus topping $1 trillion in China for the first time. And China clearly doing extremely well with its exports. Welcome. We're just moving on to the geopolitics part of the discussion, but we'll do introductions after. Just by the tension, I think what's really interesting here is China, its exports to the US have shrunk. So it is not really dependent on the US in the same way that was thought. And whereas this power balance may have been a bit too much interference, whereas this power balance around trade was thought to be, they had to have both power brokers. Essentially, if China is exporting less to the US, we have perhaps already these alliances being made and the relationship being circumvented. And that there is definitely, with China very strongly a tech dominant economy, what does this say about the geopolitical alliances that we have? I think this is, again, I throw this open here to the floor. One of the phenomenons we have observed at Moneta, and we're not unique in this, but our clients ask us, well, this geopolitical threat and that geopolitical threat, or this internal political threat, and it doesn't impact portfolios at all. They seem to be very resilient around that. They don't seem to be factoring in any form of concern around geopolitics. And is it the case that we expect some of this disruption to just be reversed and that we will go back to business as usual? Or I would ask the question as to whether some of this damage has been irreversible, essentially, in terms of trade relationships, our farmers, soybean exports, and whether we cannot really fathom what will be in place once some of these tariffs are removed, because it'll essentially be a new order. And is this an uncertainty that markets have not really taken upon themselves? So I think markets, we know, hate uncertainty, and they reacted violently to Liberation Day, but they've normalized tariffs relatively, I'd say, quickly since then. We seem to think they don't impact prices, although we know they do, but there seems to be a narrative that they don't. And at the same time, then, meanwhile, China is doing extremely well, thanks to other trade relationships. It's not as dependent on the US that have been overlooked. The other themes clearly in equity markets, which I think are behind the scenes, is we still have, I didn't put in this deck the complex web of AI interconnectivity, but this meme of, we're all just, it's basically just a house of cards which has been supporting each other. We have the code red, which is now being explained. It's just the upping of the ante and the arms race among AI developers, and then the cutting of metaverse, 70 billion spent on metaverse, because that's just cast aside in the plans to really redouble efforts around AI. So we're speaking with the law of very large numbers here, with I think not a great deal of understanding necessarily as to how the accounting works, as to how the codependencies work, and as to who the winners will be. And it seems these are the questions we're getting at Moneta all the time, as to whether the OpenAI is about to go bankrupt, and whether this 40% concentration in equities is something that they should be rebalancing away from. And this bubble talk has become so pervasive now that it seems like it's almost normalized again, just like Liberation Day and tariffs. Quick talk on bonds. Bonds, again, we talked about this a little earlier, clearly showing nothing but resilience, and it seems very little concern for any of this potential credit risk or elsewhere. It also means that because spreads are so tight, they're not particularly interesting as an investment opportunity. So pure play fixed income does not look like good value today. Cash will start earning less as rates fall down and as inflation stays high. Where do you put it? European spreads are somewhat wider, so perhaps Europe presents better value, but it's been a difficult place to allocate assets in fixed income overall. And just talking about private credit here, I thought there were some very interesting charts. These were in some of the JP Morgan booklets this week. Some interesting charts about the landscape for private credit and how it's changed. And what we talked about before, it's private credit we speak about now, 2 trillion plus, probably even higher now, growing as we speak. Whether the risk has essentially from fixed income been shifted into private credit. Thought it was interesting to see that the percentage of middle market leverage buyout loans, which are syndicated debt, has fallen significantly, and direct lending is now taking the lion's share of that. And then when we look at private credit, we can see just that the high yield bond, the amount outstanding there has, as a percentage of US GDP, is over 20% now. So if we add everything together, that's up from about 8% about 25 years ago. So private credit as a market share is representing a lot more, which is why it's getting the attention of journalists around the world. Equally, when we look at non-bank financials, and the financial assets held by them have soared. That's the blue line there. But interestingly, there hasn't, and maybe there's some insights from people who work at these firms, there has not been the participation in the stock market recently by some of these diversified financial firms. It has been traditional banks that have done a lot better. And why has that been? Given that all the action maybe has been with these diversified financial firms, it seems that there has been, whether it's a lack of understanding as to the strategies, whether it's a concern about crowding, about pricing, but the KKRs, the Blackstones, that they have generally not performed very well in the recent stock market. Traditional banks, until today's comment by JP Morgan about expenses overrunning, were actually doing extremely well. So we get asked all the time is, can this continue, and how is it being supported? And what we often hear is that the earnings point is very much there, that we look across the different sectors, the 93% of healthcare beating earnings, and that basically almost every sector more than half beating earnings in the latest set of in the third quarter. So clearly there's either very careful management of earnings going on, or they are performing extremely well. I look at this as kind of a glass half full type scenario, because I ask, well, why are earnings surprises so positive? Is it because cost cutting has been robust, which generally translates into job cutting? And is this something, this is being rewarded clearly, but is it something that we should necessarily be rewarding? I'm not sure whether any of you have any thoughts on valuations, cap increase.
say I can kind of reverse the question a little bit back to you, is if like you rewind the clock back to 21 going into 22, and now we have 25 going into 26. What was on your mind, given the type of role you had, concerns that you had based on your comments now, going from 21 going into 22, because 22 was obviously not a great year, and we've had 3 pretty good years in the stock market. And what do you have on your mind as it pertains to this 25 going into 26?
It's a really interesting thing to look back at where we were this time last year. I mean, clearly we just had President Trump elected. There was a lot of talk about tariffs. It hadn't yet come to fruition. There was the bark versus the bite. And but there was, I think, a bullishness as we went into 25, because there was a sense that this pro-growth, this tailwind around crypto, that was, I mean, it's been a tremendously eventful year, all said, even though we've ended up in a good place, and the volatility around AI all kind of focused in 1 month around November. What are we concerned? I definitely feel that an equity portfolio which has single stocks that are representing 5 trillion is not your grandmother's equity portfolio, in the sense that a single stock now can dominate. It can be larger than 2 stock markets, the UK and Switzerland, they put together. And that translates into a far more volatile portfolio. So I think that should be diversified, even if it means you're not participating in this market cap capture, that benchmark capture that you would. And we have to at least coach institutions and investment committees and individual family offices that this is not the kind of risk they signed up for when they signed up for the aggressive side of the risk spectrum. That this is a different kind of risk entirely. It's fine if that's what they understand, but that kind of, if intraday volatility in a stock could be 10%, and that is a $5 trillion stock, market cap stock, that to me is much more. So I would be much more in favor of that old fashioned rebalancing across these sectors, across cap sizes, and out of the US. And that's where, and into some of the other asset classes, which we have here. But it's not a very exciting call, but I think it is a necessary call, because I don't believe a lot of the, I think a lot of the strategists are very bullish on 26. And I think it's a memory is, I think it's become a point where the bears are getting worn out from their bearishness. The Michael Burrys have closed their fund. They said it doesn't matter. They're essentially out of the market. So I've just got a couple of other things just to go through different sectors. So we talked about real estate, and some interesting things around the spending on data centers now. The annual rate of spending is almost reaching office. So I think that can tell us where we are in terms of industrials and data centers. And then back to the JP Morgan, this Mike Sambalist, I think you call it in deep end. I think you call it this a great report. There were some nuggets on real estate and private capital, which I think I'd just like to share. One was a residential vacancy rate ticking up in the US, and particularly in some markets in the Sun Belt. I thought that was a bit of a warning light that was going off for me anyway. Similarly, the industrial vacancy rate ticking up. And I asked a manager upstairs about that. And he said that was to do with some of the overbuilt areas like the Sun Belt. But it still strikes me that we're not fully taking into account. These are certainly industrials has been the darling of the real estate sector, and that has been ticking up. And then there were some other kind of surprisingly positive things I saw here, such as City of London, where I live now, and risks running out of top office space. So that was again in the category of headlines I never thought I'd read, because especially not in 25, because it seemed that office was dead, top office space was empty, but yet for the high amenity back to the office crowd, they're actually running out of space. So that's a very good sign, low yields there. And the other interesting chart compares supply and vacancy. And what we can see is that the places with the highest vacancy, it's like office and retail, have had actually very little supply. So there's been that elasticity that seems to have responded to that. And then we have lower vacancy in apartments and industrial, and a lot of supply. So is that going to be leading to, we talked about the condo market in Canada, James, falling off a cliff. So I think, we talked about the K-shaped recovery earlier. Where is this? How does this square? How is Main Street experiencing this current cycle? And is it a lot worse than we think? Because, are they going to get the demand they're expecting for all of these new apartments that they're building? We're in Florida. It seems to get a lot of attention from a real estate standpoint. we heard from James on good authority that that condo market in Canada is a bad place.
Oh yeah, they
Um,
just threw out like 95% of the people, just gave them the money back. So instead of 500 square foot places, we're gonna do thousands. You just change everything in the building.
So that's a
Thing like-
reduction of demand. Yeah, so I know I'm going to keep you on time. I know that we are kind of coming up against the time. So real estate, a couple of nuggets there. Retail train, clearly alternative investments in retail, the massive spike there. That is getting more attention positively and negatively. And let's look at some of the very quick slides in terms of performance and dry powder and distributions. And just in terms of buyouts, what we're seeing is this unrealized value in global buyouts really spiking. So a lot more is on the unrealized side than the realized side. We also have exit activities quite far down. This is by a number of exits per quarter, the top bottom right there, and the unmonetized venture and buyout spiking. So we know that the exit environment has been poor, but finally now we have some charts to actually kind of put numbers on this. And then when we look at the buyout performance, this granted is going to, you will always see performance taper off as the vintage year increases, because you will not have seen the kind of returns on the recent vintage year. But to see that tapering off dramatically of performance for US buyouts and US venture, this seems like
Slides are good off.
this is, oh, sorry, I'm going the wrong way there. Thank you. I went up the wrong. There we go. And this is the one. Yes, thank you. So clearly this is spectacularly bad timing for this to now democratize. It's the classic capitalist problem of when we democratize losses. Are we just about to start democratizing an asset class just at the time when returns are starting to erode? Of course, there's a narrative around this, and many would suggest that this is an average, and we're talking about cherry picking the best, etc. But it is interesting to have some actual numbers here on private assets, because I do think it is concerning that this has finally come to bear. And I'm going to just talk about two other asset classes, and then we can finish up the discussion. And if anyone needs to leave, they can, as I know we've gone over. But clearly, Bitcoin, it's not something we invest in at Moneta. Get a lot of questions about it. We've always wondered what the role of that is in a portfolio, and that's because we haven't been able to identify a role. We thought it was maybe a currency diversifier. It was certainly not a risk hedge. We thought it was a risk enhancer. I think it is a risk enhancer. It is, to me, it sounds like it's like a bellwether at this point. It is Bitcoin is that flashing light that tells you when the real risk appetite is starting to get stale at the edges. But what we do also get asked a lot about is gold. I think we know from this slide comparing silver, gold, and Bitcoin that Bitcoin is not digital gold. It's far from it. It has dramatically diverged from gold in recent weeks, although it did keep pace for a while. So we're I say still at the discovery phase when it comes to Bitcoin, but it's been interesting to see how the risk appetite has moved around with respect to that. So that's the end of prepared remarks, because I wanted to try to keep us to the half hour. Hopefully we cycle through some of the things that are on our mind, and this is where you can find our podcast. The name is here. We come out every Friday, and that's my legal disclaimer. But I'd love to hear if anyone has, we'll leave that up for a while. If anybody has any thoughts on any of these aspects, the other asset classes, the so-called diversifiers, and if anyone needs to leave, you can. No offense taken. I know we've gone over a little. Real estate showed, some surprising pockets of upside and some surprising, perhaps, weakness. Clearly, we've got now slide numbers to show for what's really going on in private assets. Other assets, gold was lucky, but Bitcoin has been less so. Anyone got other thoughts on their mind?
Credit space, because that seems to be bit by bit, mentioned in the various publications, nothing major, but I think if you look at, I think the high yield market and the private credit market are roughly the same size. And we had a correction in the high yield market. It was 2018. I don't remember the exact year, but it was within the past 10 years, we had a correction in the high yield market. And it was a lower end of the high yield market. It was contained. There was no contagion that went through to the other end, or the higher ends of the high yield market. A concern I would have is private credit hasn't been tested yet And I wonder if there is a correction, is at the lower end, meaning that the guys at the upper end of the private credit market, they're not doing anything wrong. They've been doing the same thing right. But then in the riskier end of the private credit market, can that cause contagion to other ends of the private credit market? We don't know yet. So that's what I'm kind of saying is like the private credit managers that have been around for a while are going to continue to do great. But is there one emerging manager that's taking a lot of high risk private credit that kind of soils the rest of the space?
Yeah, I mean, this idea of resilience has been tested. Like, oh, it hasn't broken, so it must be strong. It hasn't broken this time. Oh, it didn't break again, so therefore it's never going to break ever. I think there's that sense that we've tested these again and again. But as we can see from the subprime crisis, which, well, and then again the retail, not the sort of the smaller banks, the regional bank crisis, that there can be a surprise. It perhaps didn't sink the entire system that time, the regional bank crisis, but it was meaningful enough that it certainly led to closures and chaos. So I think you're right, but there will be a strain that they have not prepared for by fighting the last war. So, do you just a view on private credit? You'd like to say something? Yeah.
Yeah, I want to share some thoughts here. So when you think about private credit, right, it's all considered monolith, as if it's just one thing. There are different market segments that you can look at, upper middle market being one, core middle market being another, and the lower middle market being the last one. When you think about the capital flows, so all the capital that has been raised, 84% of that has gone to mega management. When you look at how many deals they closed in 2024, it was about 174. In the lower middle market, is more fragmented, so you get access to a third of the U.S. economy. And when you look at last year, it was about 6,300 companies. So there is a lot of headlines, private credit, but it's a ginormous market space where you don't necessarily have to go for one. You can diversify, no different than, large cap, mid cap, small caps, no different in the private credit space. Manager selection is always key.
Yeah, I mean, just adding 2 cents to that as well. I think the experience that you're talking about, that there hasn't been a correction yet, and we're unsure of where private credit might have its burst, if you will, and that's been a headline recently. And I think what we talk about is saying that similarly to what you shared, there's complete diversification in terms of manager selection, large cap, mid, small cap. And then the only thing that I would add to is there's a sense of a little bit more security in terms of the private markets, because you can't access your money right away, right? So there is that built-in restriction, that the fear that you experience in public markets, right, that prevents you from taking money out immediately. But at the same time, that can compound, and people get anxious when they can't get all their money right away that they request. So I think there's just a general sense of, where are private markets leading towards? And I think that private equity market that you were mentioning earlier, that's where we're seeing the less exits, that sort of thing. And I'll be curious how we raise for private equity in just the near-term future, and how people will respond from that perspective. So I think I'm looking at both credit and equity side and from a private standpoint, but I still think we're in a great shape to have the diversification, because as you said, the single stocks that we're looking at right now, or where the stock market is today with sole concentration, it's not enough to have the diversification for a long-term experience that buyers are looking for.
And I've always found fixed income managers are typically the bearish ones, right? They're the ones who worry about getting paid. And I've always found there's more realism in the private credit discussions I've had. That they talk about the first brands, the tricolor, and they looked at it and then what was wrong, and they found this and that. And we hear about the ones who were caught by that, but not the ones who looked at it in the past. And that gives me some, I see less perhaps exuberance in private credit that I'm hearing from strategists today, which is a little surprising given that there's no dog in that fight necessarily if you're a strategist. And also equity managers today seem to have this exuberance, which I don't think is justified based on some of this pain. If someone's shopping basket is 30% higher this year, there is no way they're going to be spending on the 5 LLM models to use and this subscription and that subscription. And I think we know that there is a pinch in that side of the economy. But there will be some of these mid-market issuers that will feel that pinch, whether it's the boutique gyms that, you know, the bar classes that they never seem to run, but they were big issuers of credit at one point. So I think there's a lot going on. So